Most people have never heard of the firm you work for. That's the point. Private equity doesn't have a storefront. It doesn't run ads. It doesn't need your business. It buys businesses. You are 24 years old. You came from 2 years at an investment bank. You took a 40% pay cut to be here. Nobody understood why. You did. At the analyst level in private equity, you build models. Not the kind that explain a company. The kind that answer one question. If we buy this business, hold it for 5 years and sell it, what do we make? The model is a machine for converting assumptions into conviction. You learn that every deal starts with a thesis. The thesis is everything. The model just tests whether the thesis holds. Your first deal memo takes 4 days, 16 pages. You rewrite it 3 times before a senior associate sees it. The senior associate returns it with comments in the margin, not edits, questions. Why does management stay post-close? What happens to margins if raw material costs increase 15%? Who are the realistic buyers in year 5? You don't answer these questions for the memo. You answer them so that when someone asks in the room, you already know. You've closed your first deal. A middle-market manufacturing company. $240 million. The deal took 8 months. You worked on it for 6. You learned more in those 6 months than in the 2 years at the bank. At the associate level, the work shifts. You're no longer just building the model. You're managing the process. Legal due diligence, financial due diligence, commercial due diligence, environmental, HR, technology. Each work stream has its own advisor. Each advisor bills by the hour. But you don't know which part until the deal closes. The associate level is also where you begin to understand the portfolio. The companies the firm bought are not investments on a spreadsheet anymore. They are businesses with employees and customers and problems. A supply chain disruption is now a margin problem. That is now a covenant problem. You learn that buying a company is easy compared to owning one. The return on this deal is now contingent on decisions that aren't in any model. You source your first deal at 31. Not because someone handed it to you. Because you spent 2 years cultivating a relationship with an investment banker. That's origination. It doesn't appear on any job description. It is the entire job at VP. The company is a regional logistics business. 60 million in EBITDA. A founder who wants to take chips off the table. The founder doesn't need the money. He needs to trust you. You spend 3 months building that trust. Dinners, plant visits, conversations about the business. When you finally talk price, he already trusts your judgment. At VP, you also learn what the carry actually means. Carried interest is the 20% of profits the investment team takes after returning capital to investors. It is not salary. It is not guaranteed. It vests over years. If the fund performs, your carry on $1 billion fund is worth tens of millions. If the fund underperforms, the carry is worth nothing. This is what aligns private equity managers with their investors, and what makes every underperforming portfolio company feel personal. You run the deal now, not as a participant, as the person accountable for whether it closes. The investment committee is the partner group, the people who have final say on whether the firm writes the check. This time, you're the one answering every question. The senior partner asks the question you hoped wouldn't come. What happens to returns if the exit multiple compresses 2 turns? The IRR drops from 23% to 16%. Still above the hurdle rate, still a viable investment. The committee approves. At the principal level, you also begin managing the limited partners. Limited partners are the institutions and individuals who give the firm capital to invest. Pension funds, university endowments, sovereign wealth funds. They do not run the deals, they fund them, and they expect a return that justifies giving their capital to a manager instead of an index fund. Managing LP relationships is not investor relations, it is stewardship. The deals are the product, the LP relationship is the business. The fund closes at $2.3 billion. That number is not what the firm will invest, it is what the firm is trusted to invest. The distinction matters. The $2.3 billion belongs to the LPs. As general partner, you are now personally liable for the fund's management. The GP commitment, typically 1 to 3% of fund size, comes from your own capital. You have written a $46 million check into your own fund. If the fund performs, that $46 million becomes significantly more. If the fund doesn't, it becomes less, potentially much less. The portfolio now spans 12 companies, 3 performing ahead of plan, 6 on plan, 2 behind, 1 in distress. The distressed company consumes 40% of your time. You bring in an operational partner, a restructuring advisor, you replace the CFO. The company stabilizes, the lender extends the covenant waiver. Managing a fund is managing 12 simultaneous operating realities. The firm's third fund closes at $4.8 billion. You have been doing this for 18 years. The firm now manages $11 billion across 3 funds. You review them. The deals you approve or decline are worth more in aggregate than the GDP of some countries. The economics at this level are not a salary. They are management fees, carried interest, co-investment returns, and the compounding of 18 years of capital. The management fee alone, 2% of $11 billion, generates $220 million annually for the firm. Your share of that is a number that no longer requires a next deal to sustain the life you have. You continue because you are good at it, because the work itself has become interesting in a way that the money stopped being interesting years ago. The LPs now come to you, not the other way around. The deals now come to you. Bankers who wouldn't return your calls 18 years ago route their best mandates through your firm first. The firm is no longer a place you work. It is something you built. 6 levels, 18 years, $11 billion under management. Private equity is not a career for people who want to be comfortable. It's a career for people who want to be accountable for something real. And somewhere in a bank, a 24-year-old just accepted a 40% pay cut to join a firm nobody has heard of. He thinks this is about the carry. He'll find out what it's actually about in about 18 years. Vault Levels. New episodes every week.